Okay. Good morning, everybody, and welcome to today's webinar. I'm delighted to have so many of you joining us as we look to examine growth and distress in the post-pandemic recovery. Today's webinar is part of our new programme titled The Uneven Recovery and marks the start of a series of new insights that we will share on what the divergent recovery means for UK businesses and the advisory community. I'm also delighted that during this morning's discussion, we'll be sharing insight from Clarity, Quantuma's new and unique data tool, which analyses the performance of UK businesses sector by sector. Clarity drills down into those businesses who are potential growth champions and also examines those which are exhibiting signs of distress and may face further challenges over the next 6 to 12 months. Our first report from Clarity will be publicly available next week. Before we kick off, please do note that the Q&A function is open, so feel free to submit your own questions in real time. I know some of you have submitted questions beforehand, and I'll try my best to feed those into the discussion as we go along. I am also contractually obliged by my marketing team to ask for your patience if we do experience any technical difficulties at all during the next hour, but hopefully not. We definitely can't blame the weather at the moment. We are joined this morning by a superb panel of speakers. First up, we have Angelika Bardalai. Angelika has over 20 years experience as an economist and is currently the head of research at the City UK, the industry body representing the UK-based financial services industry. Previously, she held leadership roles at the Economist Intelligence Unit and Eurasia Group, working in both London and New York. We're also joined by John Mould. John's an experienced board director, having led numerous financial services businesses as CEO, CFO, and COO, including New Star Asset Management, Hermes Investment Management, and Morgan Stanley. John was latterly the CEO of ThinkCats, where he presided over a fourfold increase in lending. Today, John is a senior advisor at Lyceum, an advisory and consulting boutique, and the non-exec chairman of Crowd Property, a high-growth property lending platform. Next, we have Andrew Holbert. Andrew is the managing director of one of the UK's leading facilities management businesses, Pareto FM. Andrew's grown Pareto to around £18 million, and it's known for its genuine commitment to social value, for being a disruptor to the facilities management sector and leading in the progression of people. And finally, but again, contractually obliged to say, not least, we have Carl Jackson, CEO and founder of Quantuma, who has vast experience in advising businesses, having worked as an advisory professional for more than 30 years, and is responsible for the implementation and delivery of the firm's strategic business plan. So I've got through my bit, now to the interesting stuff. Before I ask John to talk about Clarity, Angelika, can we start with you? With recent major international events, would you mind by giving us an overview of the current global and macroeconomic events and the outlook for the next 6 to 12 months?
Well, thanks, Simon, and good morning, everyone. Yes, it is certainly a fascinating time to be looking at the global economy and business, so I'm delighted to be here. I'm a little bit less delighted to have to say that I think the outlook for growth is pretty gloomy, one might say. I personally really don't follow sport very much, but actually on this occasion, the analogy that springs to mind is from boxing. In fact, it's, the idea of the 1-2 punch. So what I mean by that is the pandemic obviously brought serious economic damage in 2020 and 2021. And then just when we hoped that, we would have at least a partial return to normal in 2022, and that would help the global economy recover. And then, of course, we had the conflict in Eastern Europe, which is sending shockwaves through the global economy once again. So just to put a couple of numbers on it, I've looked at, for example, the forecast made by the OECD. OECD now expects that global GDP growth could be around 3.5% in 2022. And that's compared with the 4.5% that they were expecting prior to Russia's invasion of Ukraine. So the direct impact of the war on the global economy is going to be felt most strongly through commodity shortages. Here in the UK, I think much of the discussion has been focused on energy security. But I think what's maybe less well known than Russia's very obvious role as an exporter of oil and gas is the very key role that both Russia and Ukraine play as commodities exporters more widely. So Russia is the world's third largest exporter, in fact, of coal. Russia and Ukraine together account for 1/3 of global wheat exports, 20% of maize exports. There are also really important metal exports like nickel and others. I mean, these are used as manufacturing inputs. And so the severe disruption to commodity exports is going to have two major effects. The first is obviously commodity price inflation, which is going to be passed through to consumer price inflation, which in turn is likely to hit consumer demand and put pressure on business profitability. And the second impact is, disruptions to supply chains. So the commodity shortages are likely to affect manufacturing and manufacturing inputs. Obviously, I think we could spend all day talking about, how the war is going to impact the global economy. But since my remarks are really intended to set the scene for the rest of this morning's discussion, let me highlight just one thing here. For the past 30 years, I think the world has generally looked to emerging markets to drive global growth. But many emerging markets are really acutely vulnerable to commodity shortages and price spikes. And so they aren't really going to be in the position to support global growth that they have been in other recent economic crises and in the way that we've been used to in recent decades. Now, I think that's an interesting point, but it also brings us on to, speaking about emerging markets and supply chain disruptions generally. It is also worth mentioning China specifically. I mean, you really can't talk about the global economy without mentioning China. It's the world's second largest economy. It appears to be grappling with a resurgence of COVID, unfortunately. So Shenzhen, it's the country's third largest city. It's a major industrial and manufacturing hub. It has the world's fourth largest container port. And it was under lockdown for a week until just this Monday just gone. In the UK, we've moved into this so-called living with COVID phase of the pandemic, but the reality is that the pandemic is far from over, and it is still possible that another variant or another outbreak might lead to future lockdowns in China and major cities, and that could place global supply chains under even more stress or major stress. So that's kind of a very quick tour, I think, of some of the major issues in the global economy. Here in the UK, the story is really very much about inflation and the impact that that's going to have on household finances and consumer spending. It is very important to remember that private consumption accounts for 60% of UK GDP. So anything that has an impact on household spending will have a serious impact on the economy overall. In this regard, I think that one of the most interesting features of the economic and fiscal outlook that was just published by the Office for Budget Responsibility on Wednesday was the forecast for the savings rate. So after reaching a record high of almost 25% in 2020, because opportunities to spend were obviously really limited because of the lockdowns, and that resulted in what economists call forced savings. So since then, the savings rate has fallen back again, but the OBR now expects it to reach a record low of 2.8% in 2022. And that supports a forecast for UK growth that's, only in inverted commas, about 2 percentage points lower than the forecast that was made before the outbreak of the war. So we're looking at 3.8% growth in 2022 compared to around 6% growth that was forecast before the invasion of Ukraine. And there are just two key points that I think are worth drawing out as we look at this forecast and this outlook. First is that the UK's long-term average growth rate is 2%. So in normal times, this idea of 3.8% GDP growth would be spectacular. But now obviously the context is what we're facing is basically a much weaker bounce back from the catastrophic impact of the pandemic. So the good news is that the economy returned to its pre-pandemic level in January, this past January. The less good news, though, is that expectations for growth are still very much below what they were before the pandemic.
Thanks, Angelica. I feel as though you were about to give us that present of the good news, and then you took it away just at the end. Just before I ask John to come in, any comments on the spring statement? Any surprises there, or was it pretty predictable?
I'd say it was fairly predictable. I don't think there were any major surprises, except maybe, the headline grabbing thing about cutting the basic rate of income tax, but, that's not coming until 2024. I think, given the forecast for inflation, it's pretty dire numbers. Inflation expected to reach, just under 9% or so in the fourth quarter of this year. And in that context, I think it was unsurprising that the fiscal stimulus was targeted at households, although there was a nod to the corporate sector and, support to SMEs with the increase in the employment allowance. But overall, I would say, no major surprises. And essentially, the bottom line is modest fiscal stimulus. Whether it's going to be enough to avert a possible recession, I think will depend on, the very many risks and uncertainties that we're facing in the outlook.
Thank you very much. So I think if I can summarize with the word uncertain as a key theme in the UK economy, John, I'd like to ask you now to talk us through how Clarity analyzes SMEs, the use of the data, and after that we'll talk through with our panelists about some of the key issues which our first Clarity report will highlight. So John, over to you.
Good. Anyway, we live in a world of data now, and I think on let's call it the retail side, Google, Amazon, probably the Chinese government as well, all analysing what we do on a daily basis, and they're looking for patterns in that data, and they're looking at the outcomes coming out of those patterns. So they play those patterns now, and they can predict what individuals are going to do. Now, Clarity is just that for SMEs, right? You take data for 25, 30 years, you look at the patterns in the data, you look at the outcomes connected to those patterns, so you can predict, if you take those patterns and run them now, what's going to happen. Now, this is done on an individual company basis. Now, invariably, it doesn't always work with every company, just like it doesn't work with every individual, but it works across the masses. So basically what we're saying is, if you have enough data, you analyze it, you can predict what's going to happen to companies, to sectors, to regions, et cetera, pretty accurately for all of those SMEs. Those 5.2 million SMEs, take out the strange SPVs, take out the large corporates, take out the quasi-governmental organisations, but the core SMEs that is over half the employment of the country, that is a huge part of our GDP that Angelique was talking about. We can predict what's going to happen to them, and that's what Clarity is about, really. Full stop. Yeah.
And in terms of some of the factors that it looks at, John, the plan is to go through a few of those. Yeah. Can you take us through them, and we can discuss them one by one?
Yeah. So what we're going to look at, to be blunt, as Simon said, was this big report coming out next week, and it's all in there. So here we've only got time to look at sort of four things. One, the financial strength of companies. Two, the growth aspect of companies. Three, we're going to look at some of the regional aspects. And four, we're going to look at the companies that are going through problems and that will need help. Yeah. So, Simon, I think I'll just kick straight off, and maybe we should just look at the financial strength score of companies. So what you're going to see in front of you is a graph that what we've done in a really crude way is we've taken all the companies and put them into these high-level sectors. Now, the first thing I'm going to say is, because they're high level, you've got lots of different types of companies in every column here, but we can go really granular. And what we've done is we've basically said which the sectors with the strongest companies in, which the sectors with the weakest companies in. There's a median of 50 there. Now, bear in mind, in every one of these bars, there are companies that are strong and companies that are weak, and this is the average, right? And this chart changes year on year on year, depending what's happening in the environment, depending generally on consumer patterns and things like that. So what we've got now is a chart that has been done in February. So it's post-COVID, post-Brexit, post all of that, but it is actually pre-Ukraine. So that will have some impact. No surprises here. Look at that red one there, accommodation, food. We know that most of those companies are having a dreadful time and they're very weak. They've been, yeah. Likewise, we've got the arts and entertainment week. We've got going across the sort of wholesale and retail fairly weak, info and comms. But let's not focus on them. Let's focus on the strong sectors. And I think we can talk about that in a moment, but I just highlight them. That all that health and social stuff obviously is strong. Public stuff that supports public companies, the public admin thing, strong. Mining, strong. Agriculture, forestry, strong. And I won't talk about extraterritorial organisations, they're a bit special. But to some extent, I think it's what we expect. So with Simon, with that, Simon, I'm probably going to hand back to you so we can talk about some of these aspects. So just reiterate, this is the financial strength of the companies in these sectors at this point in time.
So, Angelica, coming first to you, I mean, in terms of those sectors, are you surprised by any of those poorer performing sectors?
No, not particularly. I think, I'd agree with what John said. There aren't really any huge surprises there, and the poorer performing sectors are exactly the ones that you would expect. Given the lockdowns over the last couple of years. And I guess, more broadly, what I'd say, looking at that chart, is it really reinforces the extent to which the public sector has dominated the economy over the last couple of years, inevitably, as huge swathes of the private sector were forced to shut down. And it's really interesting because you can actually, so we see this in the FSS financial strength score chart, but you see it reflected in the macroeconomic variables as well. So, government spending in the UK used to represent about 19% of GDP. And in the last couple of years, that's nudged up to like 22%.
And thanks, Angelica. And Andrew, as our entrepreneur on the panel, your views on the, I suppose, the general picture this paints? I think.
Yeah, I think I agree. It's not a surprise that organisations serving public sector have done well through this time. That's just standard through COVID, I think. But certainly, as an opportunity, I see is a lot of the services around food and beverages that did so poorly through COVID. They will come out the back of that, and there'll be so much entrepreneurial opportunity within there. We work a lot within the corporate property space, servicing offices. And there were I spoke to some catering organisations that their income went from 100% to 2% through that period. Now, they will come back from that, and many companies have gone bust or they've been bought out through this time. But actually, I see opportunity in that red graph that was just highlighted there, because actually there's now a chance to do it better and do it differently. And of course, through any difficult period, the weaker businesses go bust and there's an opportunity to come in and do it better. So I just think this is not a surprise, but it is a land of opportunity still.
And Carl, just coming to you for a second. I mean, in terms of the advisory side across Quantuma, are we seeing specific sectors with more challenges and indeed more M&A activity, or is it a range of sectors that are coming through?
Morning, everyone. It won't come as any surprise to you and the audience that my views are pretty much aligned with the comments that have already been made. Look, undoubtedly some sectors have suffered as a result of what's happened in the past. Again, this is pre-Ukraine, pre-Russia. Those sectors are, as John's quite rightly pointed out in his first graph, accommodation, retail, particularly those retail businesses who haven't sort of adopted to the online world that we live in, hospitality and entertainment. So it's certainly across the board, and we by and large, our business is represented in all of the key commercial centres across the UK. We are seeing levels of distress in those sectors. I mean, Andrew's quite right that actually for those well-run businesses, even in those sectors, there are opportunities going forward. But on the opposite side, there are also businesses which haven't been well run, which aren't well funded. And we're seeing now signs of distress, mainly because actually the government support measures have now by and large been removed. And of course, at the end of March, landlords are able to once again pursue arrears for rent. I mean, I think, so there are sectors which clearly are struggling and will continue to struggle. But I mean, I would also say that actually there are challenges across the board for the reasons that Angelica said, i.e. we have some major supply chain issues which have been around for a while. And even for those businesses which are in demand and subject to growth, they can't get their supply chain sorted. They will have problems. And likewise, again, I repeat what Angelica said, with the rising commodity prices, businesses need to factor those in. So look, it's a mixture of both. Yeah, so my views are very much aligned with others on this panel.
Thanks, Carl. And Andrew, just coming back to you, this concept of a well-run business, arguably in a way, is slightly different now to how it was in February 2020. The effect of COVID, from your point of view as a business owner, an operator, and dealing with lots of other businesses, what's your view on the short-term effects of COVID and the way businesses adapted versus potentially those business changes which are going to see more traction over the long term?
Yeah, well, I think COVID highlighted a lot of fragility in organization systems and organizational structure. And I think one of the things a lot of our clients saw originally was when 95% of the business is working from home, the VPN system could only support 20% of the business, for example, not 95%. And those early days of COVID were a complete nightmare. I think furlough artificially propped a lot of organizations up, which we've talked about. And actually furlough for service organizations like ourselves was a savior, but actually now that's come to an end. And now the reality is biting a bit more, I think. So I think, furlough was an incredible thing and saved an awful lot of jobs through the middle of the pandemic. But actually now I think a lot of organizations are waking up to the fact that that money was not real. And some of the money they were taking to profit was not real at that stage either. And now it's about how they grow out the back of that. I think this will be a very challenging 12 months for a lot of organizations, certainly that were people heavy, and certainly that didn't have an enormous amount of cash reserves within their organizations too. Cash was so important through the pandemic because clients weren't paying on time. There were lots of issues around services being dropped at short notice. So I think there should be a greater focus within organizations on liquidity and cash position to move forward. But also it's about waking up to not having the government wrapping their arm around us anymore and actually getting back into the real world. I think there will be a lot more distressed purchases in the next 6 to 12 months. And hopefully for the insolvency divisions of these organizations, they may have a bit more work to do because they're not artificially being propped up at this stage.
Andrew, thank you. And just staying on that point, Angelica, I listened to a lot of coverage yesterday on the spring statement, and there seemed to be a lot of references to the fact that the government weren't doing enough to support businesses. And Andrew's made reference to this point around the government support and the government having their hands round businesses and keeping them going. How far are we from a normal environment for business operation, and how long have we been in a kind of slightly manipulated environment in that way?
Yeah, no, I think that's a super interesting and very, very important point. Obviously, there's a kind of philosophical question around, what exactly is normal, but we can leave that one aside in the interest of time. I would make the point that this Russia-Ukraine crisis that we're facing at the moment, if you think about it, it's the fourth serious economic disruption that the UK has experienced in the last 15 or so years, right? And each one was considered an extraordinary event, but now we've had 4 extraordinary events in 15 years, which is quite remarkable. And yeah, just in terms of this idea of, Andrew, I love the image, right? The government kind of wrapping its arms around business and the private sector. But yeah, it's very much the case. So last year, one of the things I did was I gave evidence to the House of Lords Economic Affairs Committee, and the subject was quantitative easing, right? And this was meant to be unconventional monetary policy, but it's no longer in the headlines. But the Bank of England's asset purchase facility persists, and QE as a policy still exists. And the parliamentary evidence session was really about unwinding. But now, of course, we're talking about higher interest rates, and that's what's in the headlines. But it's worth remembering that even with the recent rate rises, interest rates are still only marginally above where they were cut to in 2008. So yeah, this sort of policy intervention in the economy, it really does persist.
Thanks, Angelica. So moving on then, John, going from current financial strength to potential for future growth. Can you take us through?
I can.
Please.
And quite rightly, Andrew being an entrepreneur sees opportunity in everything. But let's look at the growth slide, and you'll see there isn't necessarily opportunity on average in everything. So what we've got here is the sectors that are growing are going to be growing and continue growing. And I think the first thing is, the average is sort of 50, is you'd expect the accommodation food to be powering out of this. You'd expect retail to be powering out of this, but they're not. They are growing on average like they always have done. So they're not, in my view, recouping old ground that they've dropped behind. And I think the panel should talk about that, because I think there are structural changes in some of these sectors. Now, what is powering ahead? Financial services a bit, that manufacturing. We've got water, sewage and waste. That's a strange one, so we don't want to talk about that. We've still got the public admin, because all those supports really are still here. And they're piling ahead. The electricity sector is, and gas supply, we think all gas companies are going bust, but don't forget there are hundreds of little renewable companies in there, and they're all piling ahead. And the health and social work is going ahead. There's no sector that's really collapsing, but there's some notable ones that are winning, and there's some of the ones you'd expect to be winning post-COVID aren't. That's what I'll leave you with that on that.
And just to clarify, John, I mean, obviously, in terms of SMEs, you have a range of data. And for some SMEs, you have more data than others. These scores are based on every company, aren't they? And
every single company, and in every company now, but it's also every company that ever existed, or the last 25 years, looking at the patterns in their outcomes. So when we test this data, we look at outcomes, and we do see that the growth companies are borrowing more, they've gone up in value more. When we come to companies that are going down, we spot the ones that are going down, and guess what? 6-12 months later, they have collapsed. So we absolutely verify the outcomes of all of this. Yeah.
Thanks, John. So, I mean, panel, I'm not going to ask anyone specifically, but
I think you've got to ask Andrew where he's going to see the opportunity in these sectors that he thinks is so great.
Let's start with that, John. That's a good idea. Come on then, Andrew. Where are the opportunities?
Well, I got to say, when I look at that chart, I feel reasonably bleak about the future. Actually, it has a Pareto curve in it. Around 80% of the growth is going to come from 20% of the sectors, which is Pareto law, right? And that's not good for the other 80% of the sectors that are within there, which look like they're going to bumble along to some great degree. I see opportunity in everything, and that's the positivist entrepreneur that I am. The way I see opportunity within that graph is I think a lot of companies are going to struggle. And as I say, go back to what I said earlier, a lot of badly run companies, this may be the end for their opportunity, which actually gives opportunity for either other organizations to diversify into those sectors, or brand new organizations to come at it with a completely fresh and new approach, maybe with a much greater focus on technology and stripping cost out of previously expensively high overhead businesses. So all of those that are below the median line there, I'd say the opportunity is probably within those sectors to come in and revolutionize from an entrepreneurial perspective.
Thanks, Andrew. And Angelica, I'm going to come to you in a second, but I'm going to go to John first. We are known as a nation of shopkeepers, but we do seem to have this fascination with manufacturing. John, we've had a question, and I don't know whether this is one you'll be able to answer now, but there's a question as to whether we can provide an analysis of the type of manufacturing we're talking about within that sector. Is it very? It's very broad, presumably.
Yeah. So I mean, let's face it. Britain is not a bigger manufacturing company as America, Germany, etc. And we have very niche manufacturing here, and a lot of cars, a lot of defence and things like that. So anyway, yes, we can. As I think most people listening will know, that every company has a SIC code and you can work your way down. Now, when you get really, just look at one SIC code, the data can be a bit corrupt due to people picking the wrong SIC code when they set up the company, but we can actually hone down and be more precise. Yeah.
Thanks, John. And so, Angelica, on that manufacturing score, looks like a sector with huge growth potential. Any surprise in that, or is, you know, are we moving from our love of retail to making a bit more?
Right. Well, actually, I'm gonna piggyback on Andrew's 80-20 split. I'll give you another one. When you look at the UK economy, 80% of the economy is services, and about 20% is industry, of which manufacturing is the significant part. We have the agriculture sector, obviously, but it's pretty negligible in macro terms. So yeah, I think it's interesting that two of the standout sectors in that chart were, one was on the industry side, manufacturing, and as John said, it's likely, given the structure of the UK economy, to be in some of the high value added areas. Probably pharma is a key one. Again, pretty obvious, especially at the moment. Automotive, aerospace, things like that. And then on the services side, yeah, I mean, financial services was a standout, and I think that kind of is also quite intuitive. It reinforces the role of that sector as an enabler of growth in other sectors.
Thanks, Angelica.
And Simon, if I can just add, this data is before Ukraine and Russia conflict, right, on this side. So actually manufacturing will potentially peak as a result of that also. So maybe even stronger than what the graph is suggesting there.
And I suppose as well, Carl, with this data, it includes a period where we've had this huge government support and the likes of furlough having a major effect on companies being able to continue. I mean, are you seeing now the start of companies falling off that edge of having had government support for the last 2 years? And while some do have that potential for growth, others are going to feel the strain of not having that support.
Let me answer that question just by going back. I don't want to be seen as just a doomsayer. Bear in mind the sort of world we live in. So I'll just go back to what Angelica said actually about 5 or 10 minutes ago. She sort of referred to like 4 key events in the last 15 years. I would actually say, well, it's 3 key events in the last 3 years, being obviously Brexit, COVID, and obviously more recently Ukraine, which as we've already said, we haven't quite seen the impact of that yet. I mean, the British economy, and you've sort of said it, we're a bunch of greengrocers, but what we are entrepreneurial, and what we've demonstrated, I think, over the years, many years, centuries, is the ability to be entrepreneurial and to deal with issues. And I don't see this as being any different. So why I'm saying that is I'm not going to be the doomsayer and say that there is going to be a tsunami of insolvencies. Having said all that, and to answer your question specifically, Simon, look, for the reasons just said, COVID, Brexit, now Ukraine, balance sheets of many businesses have been deteriorated. No question, they've geared themselves up, whether it's through government loans or actually taken advantage of extended payment terms to PAYE, or actually taken advantage of the fact, and I mentioned this earlier on, that I've not had to pay my rent, furlough, etc., etc. Now there has got to come a day of reckoning. And the problem we've got, even in those businesses where there are growth opportunities, and Andrew's mentioned it, so has John, the problem that some of these SME businesses have got, they're not going to be able to take advantage of those growth opportunities for the simple reason that their balance sheets are too weak. They haven't got the cash. I mean, it's a classic, what I call over trading position, where actually demand is significant, but they just can't actually service that demand. So I think as a restructuring profession, our expectation, yes, you're going to get lots of businesses which will just go into liquidation. Lots, and we're seeing that already. But I think we're more likely to see, as a restructuring profession, those businesses which underlying are viable because they have demand, they can see opportunities, but they simply haven't got strong enough balance sheets. And that's going to be the challenge for us as advisors, and the challenge for entrepreneurs in spotting that problem early enough, seek early advice. And it's always what we say to clients. And there are opportunities. I mean, lenders, I think, will be cautious at the moment, undoubtedly, because of those weak balance sheets. And typically, entrepreneurs will always want to go to their banks, their lenders, to seek additional funding. And there will be a degree of caution because of the current circumstances we're in. So, look, not all bad news, but I think there's going to be a flurry of what I would call restructurings, whether informal or formal restructurings. And Andrew sort of mentioned earlier on distressed sales, I think, where a company with a viable business but simply is not able to trade because it's weak balance sheet. I think the stronger competitors will be looking to cherry pick and buy those businesses.
And we'll come back. Thanks, Carl. We'll come back to the I suppose the distress side later in the report. But sorry, John, I just want to touch on with Angelica because it follows on from Carl's comment around that investment side and growth through having the money to be able to invest in your business and grow. In the Treasury's spring statement, I will just read you a quick excerpt, Angelica. It says, the UK has a long-standing issue with productivity, and one of the key underlying causes is a lack of capital investment. Our companies invest just 10% of GDP each year, compared with 14% in our competitor countries. Our tax system doesn't reward investment as much as other countries do, so the government is investing 600 billion over the next 5 years. We want businesses to invest more too. Is that just noise, or is there a genuine issue which they're trying to solve there?
Yeah, I don't think it's just noise. I mean, that is absolutely the case. Business investment is around 10% of GDP. And I guess what I would say is that economic stability and growth prospects and policy certainty are really what I would pick out as the sort of fundamental drivers of business investment. So, talking about, where we've come from and where we want to go. I mean, if we're talking about getting back to a place where policy normalizes, in inverted commas, to where it was pre-global financial crisis, to be honest, I don't know if and when we're ever going to get there. But what I would say is that, the right enabling environment, which is essentially putting in place the factors that will support sustainable economic growth and policy certainty, that's what we really need in order to see a sustained uptick in business investment.
Thanks, Angelica. John, do you want to say something?
Yeah, I want to be controversial, right? The data says that over a 7-year period, a third of SMEs either go bust or shut down, and a new third start up again. Now, that is required to get innovation, right? And if we don't have that, we don't innovate. Now, the problem is that due to all these hand-holding help measures, be it COVID, furlough, quantitative easing, we haven't had enough insolvencies. We haven't had enough restructures. We haven't had enough to keep that innovation growing. So actually, it sounds really perverse, and we'll talk about how do we keep everything going. We actually need a lot to go bust, and out of that death and destruction, the green shoots will come. Anyway, that's all I wanted to say in a really brutal way.
Thank you, John. I can trust you to be the brutal one. Just before we move on, I've had a question in for you, John. Is Clarity backwards looking, or does it look forward, i.e. propensity, and are the inputs limited to companies' house filings?
So there's hundreds of questions in there. So the answer is no. There's companies' house data, there's data from Experian and various other credit rating agencies, et cetera. So what it does is it looks, as I said earlier, at historical data. What happened? It runs a sort of film on companies in the past. What happened to that company with those characteristics in the past? Oh, that was the outcome, right? So what it then does is take those characteristics and it tests that, and then it takes those characteristics and runs it on companies now, so you can predict what that outcome will be. So that's the forward-looking thing. It's learning from the past to predict the future.
Thanks, John. Okay, so moving then from that growth side, now can we just have a focus on the regional
Absolutely.
Of SMEs.
We've got a slide. So the question is, do we need to level up, or is it, sorry, does the government need to impose leveling up, or is leveling up occurring anyway? Okay. What we've got here is we've got something called a distress warning score, and I'm going to talk about it, a growth score, that financial strength score by region. Let's just focus on the growth one because I think that's most interesting. You can see that the regions that are growing most at the moment are Wales, the Southwest, Scotland, and the Midlands. I don't know if that's a surprise. I think what is a surprise is the region that is growing least is London, followed by the Southeast. You know, I have some views about that, but I won't mention them now. I think we should, as a panel, we should discuss that. So personally, I think this is great news because it helps with that leveling up agenda. And to be fair, the North is not far behind Scotland and Midlands. So I think that's, I'm not going to say any more. I think we should just discuss this a bit.
So Andrew, I'm going to open with you then. Views?
Yeah, this isn't a surprise to me. I think, again, working with a lot of large corporates that have mainly head offices in London and then regionals across the rest of the UK, we are seeing those London offices a lot more quiet than they have been, of course, for the last couple of years. And also we're seeing a real focus on trying to encourage people back to the office, but not a huge commitment to people wanting to come back to the office at the moment. We're certainly seeing more people wanting to work from home and be based further away from the London sort of area. So outside of your Readings and Oxfords and Sloughs and that sort of thing, move away from that area so that they can have the bigger house with a bigger garden, you know, and a better quality of life, and not expecting to get up at 5 a.m. every morning to go into London and sit in an office for 11 hours a day or whatever it is. So it's not a surprise to me that we're seeing growth in those areas outside, because that's where I think more people are going to be spending their time, and hence will deliver growth in those areas. The challenge we're seeing within organizations is, how do you encourage people back to the office if that's what we want to do? And the way we're seeing companies do that is by trying to hold more specific events that are happening on certain days to give people a reason to come back to the office, and also a redesign of the office space to make it a more enriched environment whilst they're there.
Thanks, Andrew. And Angelica, just coming to you, is this a COVID effect, or is it a longer term effect? Is it a government policy effect? What are the factors that mean that London is at the lower end of the of performance?
Yeah, I think it's a combination actually. So the factors I'd pick out, one is essentially what you call base effects, right? Because in structural terms, you know, London accounts for something like, you know, 20-25% of UK GDP, even though it's only got about, you know, 13-15% of the population. And it's, you know, region-wise, it's definitely been the biggest contributor to growth. And so, you know, it was starting from a higher base. And so then when the country as a whole is faced with, you know, this big exogenous shock, it's not really surprising that that from the point in time now, when you look ahead at growth prospects, you know, from that high base, London's growth prospects don't look amazing. So part of it is structural. And then, yeah, I would say on top of that, London has probably been uniquely vulnerable to some of the effects from COVID and Brexit, like immigration, and, you know, the fact that some of the hard hit sectors during the pandemic that we discussed earlier, like accommodation, food service, hospitality, leisure, you know, they're a pretty key part of the London economy.
I mean, just to reinforce that point, this is not unique to the UK. I was in the States for 4 days last week in South Carolina, but actually just talking to a real estate guy down there, and he was saying property prices in South Carolina had shot up by about 25-30%. And what it was people from New York, the major cities, actually realizing that they can do a lot of their business at home in a nicer environment. So to me, the COVID has been a big driver of this, but I don't think we'll ever go back to where we were 3 years ago. I think it's here to stay. I think it's a mixture.
Thanks.
Be quite interested to see those stats. Sorry, Tim. Be quite interested to see those stats again in, say, 6 months' time.
Well, I'm sure we'll be able to see them in 6 months' time.
Just to say on that, we've been very broad. We can actually go down to individual postcodes if required, and you can compare your postcode to your next door neighbour's postcode.
John, we haven't got time, believe me. So just before we move on, John, just one last question for you. Everybody's head explodes, I think, when they start kind of trying to figure out the data that goes into these things. But just one point for me is around this idea that, you know, I'm presuming you can collect a lot more data on London. So does that skew the results, or does it not make a change? No.
One of the things I want to say is, we're talking London, and everyone's thinking about the city and all these massive buildings. You must bear in mind that 95% of London SMEs, or even 98%, are the grocer, the nail bar, or the sandwich shop. So they're not. Those big companies are such a small percentage, and a lot of them, of course, aren't even UK companies anyway. So no, there's no more data on London than anywhere else. There is more data on bigger companies, but London's full of small companies.
Thanks, John. Right, our last area to discuss, I believe, is the companies that are at the more challenging end of the spectre. So, John, over to you.
Yeah. Okay. So what we've got coming up is just an example of insolvency propensity. So the same way we can look at the characteristics of growth companies, or the high growth companies, etc., we can look at, by looking at the past, which companies are going down. Now, in an ideal world, we don't want to wait for them to collapse. We want to go in and help them innovate, do the restructuring required. So for every sector, and this graph shows the sectors on the left, we can tell you if a company is, 4 times more likely to go bust than an average company, 8 to 15 times, or 15, 25 times. So we can literally tell you if a company is 25 times more likely to go bust than an average company. Now that is brilliant, because they are the companies that we can go in, we can help, we can turn around. I did say, when it comes to go bust or regrow, they don't need to go bust to regrow. They're the companies that need to relook at what they're doing and how they're doing it. So from a Quantuma point of view, this is very good, because it can, we can just work to help people, basically. Yeah. I don't think I want to talk, we have detail of which sectors are more prone to have insolvency and problems in them, but we're not showing that yet.
And just while the slide's up, this the 3 different areas. So the percentages at the bottom, I think I'm right in saying, are the risk of insolvency, aren't
yes.
they? So those where the blue is, the risk there is identified as between a 15 and 25% chance. In the next 12 months, they will end in some form of insolvency process. Yeah.
And the assumption is quite rightly that the average insolvency rate is 1%, so it's 25 times. Absolutely.
Yeah. And in terms of those numbers, John, I mean, the 100%, that's obviously below a certain level in terms of the distress. So it's the companies that feature in each of those. Yeah. Okay. And
I think there's one thing I'd like to say. There's about 500. Looking at these behind here, there's companies, and we know the names of those companies, and there's 500,000 people working for those companies. Yeah. So if one can help them, it saves 500,000 people losing their jobs, retraining, etc., etc.
Thanks, John. And Carl, you touched earlier on the overtrading concept. So I'm assuming in here, you're not only going to see those companies that have had a decline in turnover or have experienced real increases in debt, you're also going to see those companies that have a severe lack of working capital, or who aren't performing well in comparison to their peers in the same industry.
Yeah, absolutely. So I guess I'm just going to end up repeating what I said earlier on, Simon. I think I'll sort of, my comment will be to sort of focus on what John said about this propensity model earlier on. And what this model does is it enables us and the company, hopefully, and their advisors to spot those early signs. So this isn't necessarily just a CCJ that's come up, or a winding up petition. You know, we can actually spot where a company's going to have a problem 6, 9, 12, 18 months ahead of any insolvency event. And actually, by working with that advisor, and your question was around cash flow, I know that there are opportunities undoubtedly to avoid an insolvency, or certainly to avoid a liquidation, which effectively means the end of a business. So look, I mean, I think, I'm bound to say it, but I think this propensity model is unique, and I think will be used in a proactive manner, and one would hope help save many businesses.
There's one difficulty. Quite often we know they're in trouble before they do.
Yeah.
So it's persuading them.
Yeah.
And Andrew, I mean, you know, the different companies, different sectors, different issues, but there must be some issues, some of which we will undoubtedly have already discussed during this morning, that all SMEs are facing at the moment, and that weigh on management's mind. Can you just touch on the type of issues you're looking at in terms of, you know, good business management, but also those risks in the next 6 to 12 months?
Certainly the risk is employment and labour resource, and the cost of that resource. We're certainly seeing within our sector, the cost of engineering, technical expertise is going up. We're seeing a higher move of rate of different organisations, of people moving around the sectors. So from our perspective, I think staff, and that is going to impact everybody across every sector of every SME. And I think that's really what will make people nervous. And I think also people are willing to change their lifestyles now. And I think there was the great resign that was being discussed in the last 12 months, and people looking to take a different path. So staff and cost of living and expectations around salaries is going to be the biggest driver. And that will obviously drive up costs, and it's whether SMEs can pass that cost on to their customers successfully without reaping the negative benefits of that.
Thanks, Andrew. Angelica, just coming to you, we've had a question in, which I'm going to throw to you, put you in the hotspot. The question is in relation to tech businesses, where they're not able to offer secure, I suppose, good security in terms of intangible assets. There's a challenge in relation to being able to take on debt. Does the tax regime need to change to encourage equity finance and reduce that reliance on debt?
Yeah, that's excuse me, that's an interesting one. Obviously, this is a very, very long-standing debate, right? And so in the UK and in Europe more widely, there's a very long-term debate about, you know, should the economy look a little bit more like it does in the US, where you know, there's a greater reliance on equity funding and relatively less on debt. So tax, yes, I mean, obviously tax policy is one important factor, but I think it would be interesting to highlight another factor that comes into this balancing act, particularly because, you know, we're talking about small businesses, and that is kind of the if you like, for lack of a better word, the cultural element, right? Because obviously equity financing involves relinquishing some control and part of your company. And I think there's, you know, yes, we could get into a very technical and detailed discussion about tax, although, you know, I'm not a tax specialist, and I'm sure our audience is not necessarily expecting that this morning, but I think it would be worthwhile looking at some of the wider supporting factors that might encourage business owners, and in particular small business owners, to feel more comfortable with equity financing given that ownership issue.
Thanks, Angelica. And Carl, coming to you, the last 24 months has seen a flurry of changes in the, I suppose, the tools that that restructuring specialists can use. The latest being that the enactment of the bill in relation to protection on rent arrears and the issues that are there. There's obviously, as much as it is normal that there is a focus on rescuing businesses, there is a recognition that there's going to be a lot more distress out there, and therefore as many tools need to be put in front of restructuring professionals as possible to be able to do that. Sometimes there's that issue that people think that when they're engaging with restructuring, they're engaging with people who are going to end up putting their business into administration or liquidation. but there is a lot more scope out there, isn't there, to save businesses and to be able to support growth and re-engineer balance sheets in order to help entrepreneurs take their companies forwards.
Yeah, look, I mean, the last 24 months, due primarily to the government measures, I think have created an artificial position. As far as companies concerned, I think they've had that benefit. They no longer have that benefit now. I mean, typically a distressed business and a financially distressed director will always display that sort of ostrich theory, head in the sand, and will only react when it's almost too late. And you know, one of our we always say it, don't we, as restructuring professionals, seek early advice. And if you do that, we think there's a greater chance of actually rescuing your business, whether that's informally by way of some form of distress sale, which at least is protecting the underlying business. There are absolutely tools out there, Simon, positive tools, which we can implement and work with businesses on, but it does require early engagement from distressed businesses. Without that, it becomes more difficult. And again, my worry is, and I'm going back to the point I made earlier on in this conversation, because of the high gearing that many businesses now have due to the debt that's been increased, my worry is there will be a flurry or an increase in formal insolvencies over the next 6, 9, 12 months, which are echoing John's point.
Albeit it does seem to be that from the comments that the panel has made, there is a recognition, and I think this is a recognition we probably all see in the wider business community, that there is a need for those insolvencies to occur. The SME market is crying out for the opportunity for businesses to be able to take advantage of the opportunities that are there, and that includes not having competition from businesses which have no real prospect in a normal environment of long-term survival.
Yep, I agree completely.
All right. I think on that, I mean, positive in the sense that I'm saying that businesses can grow off it, but maybe negative in the sense of there needs to be some failures in order for those good businesses to prosper. That is all we have time for, I'm afraid. I think it's just in terms of clarity, John is our whiz in relation to the data and the information that Clarity provides. And as I said earlier, the report will be available next week. It does raise some interesting, thank you, John, for waving it. It does raise some interesting, very interesting areas in relation to both those growth opportunities, the regions, the sectors, and also distress by sectors. And I would encourage anybody to seek out a copy when I think it's Tuesday that it's available. But going back to the comment of the panel, it does seem that unfortunately, and I feel as though it's a constant Groundhog Day, uncertainty is the order of the day. There are challenges, and going back to Carl's point, this idea that we've had 3 global issues in the last, well, Brexit maybe not quite, but in the last 3 years, there is a lot of reasons for businesses to feel uncertain. But you know, Andrew is always going to be the man that says the opportunities are there if you seek them out. So on those notes, thank you very much to all of those who have joined us, and thank you to all our panelists for taking time out of your day to share your knowledge and expertise. As I said before, the Clarity report will be published next week on Tuesday. And if you'd like to get in touch with a member of the Quantuma team or John Mould, contact details are on the screen now. If you'd like to know about Clarity and how it could help your firm and clients, please do get in touch with your local Quantuma office, or you can email the help@quantuma.com email address with any queries, and we'd be delighted to assist you. Thank you very much, everybody, for joining us today. Enjoy the sunshine and have a great weekend. Thank you all.
Thank you.
Bye-bye.
Bye-bye.